Hello. We're going to be looking for the next 20 minutes or so at exercise 17-11 on page 1055 of Spiceland's 7th edition, Intermediate Accounting for Accounting 222. In this problem, we're looking at components of pension expense and journal entries that we'll have to do to record the pension expense. Now, there are a lot of facts given in this problem. It's very similar to Connect exercise number 3, but in it, we're looking at Berry Financial Services, and we have a lot of data, including the following. The discount rate is 7%. The expected return on plan assets for the pension are 10%. That's the expected return. The actual return did not turn out to be quite as well, and only turned out to be 9%. The service cost is $310,000 for the year 2013. At January 1st, 2013, the projected benefit obligation was $2,300. The accumulated benefit obligation was $2,000. The plan assets, the fair value of them, were $2,400. Think of that as $2,400,000 when we add the zeros. Prior service cost from 2013 were $325,000. Net gain, $330,000. Although for the prior service cost, there was amortization of $25,000, and for the net gain, there was amortization of $6,000. Net gain again, for the amortization, other comprehensive income, the total dollar amount's $330,000. This year's amortization, $6,000. There were no changes in the actuary's assumptions. At December 31st, 2013, there were cash contributions to the pension fund of $245,000 and benefits to retirees of $270,000. That is, contributors paid $245,000 in, benefits paid out to retirees were $270,000. So our two required steps are, first, determine pension expense for the year 2013. That's what we're going to do in step 1. And then step 2, prepare the journal entries to record pension expense, gains and losses, funding, and retiree benefits for the year 2013. Well, key to doing well in this problem is using illustration 17-12 on page 1024. Here we have global companies' pension expense and how it's determined. Using that as a guide, I've created something like this. And there's some wording you don't see. Let me go ahead and pull the slide up and down so you can see it. First of all, the pension benefit obligation, or PBO, the service costs provided by the problem were $310,000. You heard me announce that to you just a minute ago. They were given in the problem. To calculate the interest, we look at the discount rate of 7%. We look at the projected benefit obligation of $2,300, and we do the math. 7% times $2,300 is $161, and since we're supposed to be adding zeros, $161,000. So when we have the service cost plus the interest, we have $310,000 plus $161,000, and so far, just because it's the end of the slide, not because it's any meaningful number, we have the total benefit obligation for this screen only at $471,000. But again, we're not complete here. There's more work we need to do. One of the things we need to do is start with the number from the last screen, the interim pension benefit obligation of 471. And then we need to come up with the expected return on the plant assets. So the plant assets fair value is $2,400, and we said we expected a return of 10%. So when we multiply 2,400 times 10%, we have $240,000. However, we do need to recognize that the expected return was higher than what the actual return turned out to be. So the 240,000 minus the 216,000 gave us another 24,000. So from our pension benefit obligation, which would have been 471,000, we expect a return on the plan assets of 264,000, and this means we can subtract that we're not going to have to pay so much into the pension benefit obligation because we're actually getting a return on some of the assets we have. So here we're going to take the total 471, we're going to subtract 264,000, which was what we expect the return to be on the plan assets, and the total benefit obligation on this screen is 207,000. Still not quite done, but we're getting closer. Just as before, I'm starting with the number from the last screen, which was 207,000. Now, I'm going to add in the amortization of prior service cost, which is 25,000, and I'm going to subtract the amortization from the net gain. In other words, the amortization of the net gain works in our favor because it was a gain. It reduces the pension expense. However, amortizing service costs from the prior period is going to increase the pension expense. So we add to the 207,000 25, we subtract 16, and the pension expense is 226,000. So let's look just a shade closer and look at it again. The pension expense that we calculated is 226,000. Now we need to record it. We've calculated it. Now we need to record it in journal entry form. So here, to do step 2, to record the journal entries, I'm encouraging you to look at the yellow box on page 1031 of your text. This has a sample pension expense journal entry. All right, what I have here for you, written out so you can see it, is a journal entry. So here we have debits and we have credits. For the debit, first debit, we have pension expense. We debited 226,000. We calculated we have a new pension expense of 226,000. Expenses are debits to make them go up. So we're going to debit pension expense 226,000. We're also going to debit the expected return of plant assets because remember, we're expecting these to contribute to our pension benefit obligation. So we're also going to debit those. Here, assets we're expecting to go up. So the pension expense is a debit to an expense account for 226. The plan assets are a debit to an asset account for 264,000. We also have the net gain of 6,000. These are all debits. And notice, because this is a net gain to an other comprehensive income account, this is really sort of like a negative equity. So it's a debit balance for us. The prior service cost we are showing a credit for the amortization for that of $25,000, and the offset, the final number, is the total pension benefit obligation for the year of $471. At this point, we have a balancing journal entry. There are a few other things we need to record here to make the problem complete. First, we're going to record loss on other comprehensive income for $24,000. We're also going to record a credit to plan assets for $26,000. Here's where the 24 came from. Remember that old slide, slide 4, where we calculated the difference between the expected return and the actual return? 240 minus 216 gave us 24. There's the 24,000 loss OCI. Plan assets of 245,000. If you look at the second part of the problem, top of page 1056, we learned that the cash contributions to the fund were $245,000. So our company's cash goes down. That means on the company's books, which is what we're looking at here, we have a credit to cash of $245,000, but the assets of the plan go up. So we have an offsetting increase in other assets, in this case retirement plan assets, for $245,000. Finally, we learned that benefit payments to retirees was $270,000. So we debited pension benefit obligation and we credited plan assets, both for $270,000. At this point, we've completed the exercise. 17-11, page 1055. Please give me a call or email or text if you have any questions about the problem. Take care.